Recording. Okay, so today we're going to talk about chapter 13 specifically. So I'm not going to talk about chapter 14 today, just because since the midterm is on chapter 13, I really wanted to focus on chapter 13. I'm going to upload separate kind of like lecture videos for chapter 14 after the midterm. But since the midterm is specifically focused on 9, 3, 10, 11, and 13, I wanted to make sure that 13 we spent a lot of time on because it's a pretty important chapter for kind of the next couple weeks. So really chapter 13 is talking about production costs. And so the first thing we want to kind of think about when we're thinking about production costs are profits. So profits are really just ultimately the goal of a firm. Ultimately, the goal of any company is to make money. And so presumably the ultimate goal of companies is to maximize their profits. And so profits are, it's a very simple calculation to do. And we can see right here that it's just the total revenue minus the total costs. And that's how we get the profit for a firm. So we can kind of break down those costs though into two separate types. The first are explicit costs. And I kind of like to think of these as costs that actually require like an outlay of money. So if you're paying a worker or if you're paying rent on a building, that is an example of an explicit cost. So something that you're actually giving money to someone for. So like if someone came to fix the toilet in your business, that would be an example of an explicit cost because that's a cost that you are paying for. Whereas implicit costs are actually a little different because they don't require a cash outlay. You can kind of think of like implicit costs as being potentially the opportunity cost of workers' time. And so for example, like let's say that I work in a factory that produces boxes, but I wanted to start my own business that produces boxes. So my wage that I could have earned in the factory that makes boxes, but not my own factory, that would be an example of an opportunity cost. Another example of an opportunity cost would be, so let's say that I own a building and I'm using that building for my business. So the opportunity cost of me using that building for my business is the rent that I could potentially get on that building if I rented it out. So basically just think of implicit costs as something that what you could be earning or could be doing with something if you were not using it in your business, or if you were not doing the labor for your business. That's kind of a good way to think of it, implicit costs. So why do we care about those two different types of costs? So we care because we're thinking about economic profits versus accounting profit. So accounting profit is really just the total revenue minus total explicit costs. So that's basically when you are, as a business, seeing if you're making profits, this is kind of what you traditionally think about. So the accounting profit is kind of our traditional understanding of profit. But that's different from our economic profit. In our economic profit is actually total revenue minus total costs. And that is the explicit and implicit cost. So importantly, the accounting profit ignores implicit costs. And because of that, it's actually going to be higher than economic profits. So let's take a look now at a question that you very well could see on an exam. Okay, so let me present this. Okay, so if you all want to just kind of walk through this question and see if you can calculate Alexander's economic profit. And definitely make sure to think through all of the costs, because a lot of times there are things in these questions that they give you extra information. So make sure to try to hone in on what is important versus what is not important. And I'll give you all maybe like 3 minutes. So let's say 2:40, we can go over the answer. And feel free, if you have any questions, to unmute yourself or type into the chat. Okay, and 1 minute warning. So if you've not answered the question yet, just make sure you put in some answer, even if it's not correct, just for the participation points. Okay, awesome. So looks like everyone has answered. So let me close this. And okay. Okay, good. So I'm glad we're going to go over this question. So the correct answer was $25,000. So let's take a look at why that was the case. Okay, so the first thing I did was I kind of went through and just highlighted the important pieces. So the first thing you want to find is profit. So what are his profits? So profits are the quantity times the price. So the pink highlight is going to be his profits. So we're just going to take the quantity times the price to get his profits of $100,000. So then the next piece of information we need to know, or what are his explicit and implicit costs? So I've highlighted all of the costs, and we'll walk through which one is which. So the first one that we need to be aware of is, and I'll kind of star this one with yellow. So the $25,000 that he pays for raw materials, so that is an explicit cost. Alexander is paying that money to someone for raw materials. So that's an outlay of money. The second one, and this one is a little bit counterintuitive, but is the $50,000 that he borrowed at 10%. So we have to calculate the interest that he's paying on that money. So what we do is we're just going to take the 50,000 times the 10% to get 5,000. So the reason why that is an explicit cost is Alexander is explicitly paying that money to the bank. So he's actually paying those interest costs to the bank. So then his explicit costs are going to be $30,000. So the $25,000 in raw materials expenditures and the $50,000 that he borrowed at 10%. So the interest payments that he's making on the borrowed money. So those are his explicit costs. Now his implicit costs, those are going to be the money he was earning interest on in his savings account, which we can see up here. And I'm going to highlight that one or star that one with a red. So the $50,000 of his own savings that he was earning 10% interest on, that is an implicit cost. So he's not paying that $5,000, but he's losing that $5,000 that he could have otherwise earned money on. So that's in the first implicit cost. The second one is him in his wages that he was previously earning at the factory of 40,000. So for implicit costs, we're going to take the savings interest that he could have earned on his $50,000, and then the wages that he was being paid at his old job. So that's going to give us $45,000. So then his economic profit is going to be his $100,000 of revenue minus the explicit costs up here, then minus the implicit costs right here. So that's going to give us $25,000. Okay, so let me pause here and see if there are any questions.
Professor.
Yeah, so that's a really, really good question. So you're asking why is the $50,000 that is included that he borrowed not included in the cost? So the reason is that he doesn't have to pay that back right away. So that's basically something that he's not paying for right away. So we're just including the interest on that because that's not something that he is going to have to pay back over the current year. He's basically going to pay that back over, a very long period of time. So that's why the $50,000 was not included. Did anyone else have any other questions on this one? Because I can guarantee you something like this will be on the second midterm. Yeah, how did you do it?
So I don't know if my logic is sound, but I had for the explicit cost just the 25,000, and for the implicit cost I had more because I had the 40,000 also, plus had he kept all his money in the bank, I did 100,000 times 1.1, and so minus the his original amount would have left him with an extra $10,000. So I've subtracted that from the total and got 25,000.
Yeah, so the one thing I'll point out there is that the $100,000 was not his own money. So only $50,000 of the money was from his savings, and then 50,000 was borrowed. So as long as you are making sure that you're like noting that distinction, if these amounts have different interest rates, that would be totally fine.
Okay, thank you.
Yeah.
The
Did anyone else?
25,000 that you have, that's for the raw materials, right?
Yes.
Okay.
Do anyone else have any other questions on this one before we move on? Okay. So now we're moving to actually talking about the production function. The production function, I feel like, is kind of a fancy way of just saying like the amount of labor and quantity produced. So basically all we're looking at is just the amount of inputs used to produce the good and the quantity of the output. So basically, like, we can think about it like in this first example here where we're thinking about wheat. So like when you're growing wheat, the input is going to be wheat, and then the number of workers it takes to actually, clean the wheat, strip the wheat of all the things that's unnecessary to prepare it to be shipped to companies that make bread. So that could be one example. Another example could be something like t-shirts. So the inputs to t-shirts would be like the machines it takes to produce t-shirts, the cotton or synthetic fiber it takes to make t-shirts. So just kind of things that go into a product. And what we're really looking at and kind of trying to think about for the production function is just how many workers does it take to produce a certain quantity. And so you can see that we normally think about a production function where the number of workers are on the x-axis and the quantity of output is on the y-axis. And we're basically just kind of mapping that as it goes up. So the important thing to note with this graph is that there are diminishing marginal returns. And all that basically means is that every additional worker you add, they are less and less productive, and they produce less and less output than the previous worker. And the reason for that is just because, let's think about like a very, very specific example. So let's say that you have one machine that produces t-shirts, and that one machine can have 3 workers working on it at the same time. So let's say that you currently have 3 workers working on that machine. If you add a 4th worker, maybe that worker can fill in when other workers are sick or other workers are on their lunch breaks, but that worker is not going to be productive all of the time. And so because of that, their additional output that worker is generating is going to be less than the output moving from the 2nd worker to the 3rd worker. So basically, there's just kind of this decreasing quantity that you get, or decreasing amount of output as you add additional workers. And we can kind of think about that as the marginal product. So the marginal product is just kind of getting at this question of what is the additional quantity produced or the additional production from hiring one more worker. And we have an equation that we can actually use to figure that out. And just kind of a note here, the delta that we see is just meaning change in. So when you see like a delta Q, all we're really saying is just the change in quantity and the change in labor. So for the marginal product of labor, what we're really looking at is the change in quantity and the change in labor. So that's kind of what we're trying to figure out. And we can figure that out based on something like this. So let's say that this is our labor and this is our quantity. So we need two things to determine the marginal product of labor. So we need the change in quantity. So basically the additional output that is generated from adding workers. So let's say moving from 10 workers to 20 workers, what is the amount of output that that is added? So we can see here that that would be 1,000 additional quantity moving from 10 to 20, and then change in labor. So effectively moving from 0 to 10. And then all we do is just take those two over one another and divide. So we're just going to take the change in quantity, change in labor, divide those two to get 100. So that would be the marginal product of labor moving from 10 to 20 would be that right there. And then we can do that moving down the entire table. So moving from 20 to 40, 40 to 80, 80 to 95, and then 95 to 100. And so notice here that actually kind of originally you do have some increasing marginal product of labor, because when you're moving from 100 to 400, that's actually giving you more when you add workers. But then note that at a certain point, we're actually going to get less. So moving from 40 workers to 80, we're actually back down to 100 for the marginal product of labor. Then moving from 80 to 95, we're actually 66.6. So basically, we can have increasing, kind of constant, or decreasing marginal product of labor. It kind of just depends on the unique factors to that specific business or that specific labor production process. So I did mention this before, but I kind of wanted to go over it a little more explicitly. And basically just diminishing marginal product of labor, we're really just talking about the product of an input declines as the quantity of inputs increases. So basically, marginal product of labor tends to decrease as the amount of labor used rises. And this is true, and this is kind of an important piece. This is true whether the fixed input is land or capital. And we kind of include both of those just because we want to make sure that it's understood that there can be diminishing marginal product of labor for like agricultural processes, as well as for factories, like building factories or building buildings. That's kind of just generally true, is there's a point where marginal product of labor is going to start to go down. And after that point, it'll just continue to decrease. And then at a certain point, it actually will become negative. Okay, and before I move on, actually, are there any questions on marginal product of labor? Okay, so let's move to costs. So we talked previously about explicit and implicit costs, but now we're actually going to get much more detailed when we talk about costs and break them down into two different buckets. So the first bucket we have here are fixed costs. And they're basically things that don't change with the quantity of output produced. So you can think of a fixed cost as basically the lease you have for a building, or the let's say the maybe the quantity of electricity you use if you run like a business that doesn't have varying electricity costs. So basically just something that is unchanged, regardless of if you produce 100,000 units or 0 units, you still have to pay fixed costs. They are always constant over the period. Whereas variable costs, as it might suggest, vary based on how much you produce. So that could be something like if you have hourly workers and the workers are producing or working a certain number of hours based on how many orders you have. So if the number of orders you have increases, the labor costs that you are going to pay are also going to increase. That can also be true for something like, let's say you have water. So let's say maybe you are a company that makes bread. So the water you use, the flour you use, those are things that are going to vary based on how much bread you produce. So total costs then are just going to be the combination of total fixed costs and total variable costs. So just taking all of those, plugging them in together. So let's take a look at kind of a cost example. So we have kind of the similar table that we had previously, where we had the quantity and change in quantity, and then we have total fixed costs and total variable costs. So we can see that total fixed costs, so the column in red, they are unchanging across the entire production amount. So you pay $2,000 whether you produce 0 or 15,100 of that particular item. Whereas variable costs, they change based on how much you produce, as we can see in this column, moving from $0 at 0 quantity to $8,000 at a quantity of 15,100. And so then our total costs, we're just going to take this column right here, this column right here, add them together to get this column. So just take FC plus VC is going to give us total cost. So that's all you have to do for fixed cost, variable cost, and total cost. So not particularly complicated, but just really important that you understand. I think the biggest thing is that fixed costs don't change regardless of the output. So that's definitely an important thing to remember. And so frequently you're going to see costs graphed, and there's a reason you're going to see them graphed. And the reason for that is basically to just kind of understand that as you produce more, variable costs become a larger percentage of your total costs. And that makes sense when you think about it. So early on, all of your costs are going to be, or the majority of your costs are going to be fixed costs. As you start increasing production though, fixed costs are going to stay constant, whereas variable costs are going to start increasing. So you can see that variable costs become a significantly larger and larger portion of your total costs. So just kind of the thing to remember, as increased production, variable costs become a larger portion of your total costs. So now we're kind of talking about this to move on to a discussion of marginal costs. And marginal costs are basically just the increase in total cost from producing one more unit of a good. And we usually see the equation like this, where we have the little delta symbol, which is just saying change. So the change in total costs over the change in quantity. And kind of an important piece here that I've added just to kind of talk about the graph shape is that marginal cost curves are usually U-shaped. And the reason for that is that marginal cost is relatively high. It's small quantities of output. And then as production increases, marginal cost declines. So basically it reaches a minimum value and then rises. And frequently you'll see marginal cost curves kind of look like a little hook. So kind of something like that. That is a very common shape for marginal cost curves. And the reason for that is just, as I said, they're high, kind of at a low production point, then they bottom out to a minimum point, and then they just kind of continue to increase and frequently increase exponentially. So how do you calculate marginal cost? So I've included an example here just to kind of help us understand how that process works. So let's say that we are at a quantity of 1,000. And let's say that we want to produce 2,000. So we're going to move from this point. So this is our first point to this point. So this is our second point. So basically what we're going to do is we're going to take the total costs. So the 4,000, plug that in right here, take the 2,000 from the previous production, plug that in here, then take the quantity. So make sure that these two are from the same row. So for example, like this needs to match. So these two rows need to mirror each other. The total cost of 4,000 needs to go with the quantity of 2,000. So then you have the 2,000 minus 1,000, which then when you solve the equation, it's going to give you a marginal cost of $2. So just kind of important to remember that process and how to get to the final marginal cost number. So as I kind of said, marginal cost is normally a hook-shaped graph. And so we can see here kind of that hook shape where marginal cost is going to be kind of higher initially, declines to a low number, and then starts to increase exponentially. Kind of, that's a good question. So it kind of is, I'll get into this a little bit later, but it's important to understand that there is a difference early on in marginal cost. So basically, this is when we're thinking about early on. So like early on when there is a, so let's say that like we were moving from a zero quantity, that would be the fixed costs. So it's usually the same as variable costs, except when you're moving from 0 to 1,000, or like 0 to 1. Just because it's 0, you don't have any variable costs, but you do have fixed costs. So fixed costs are still included initially. So that will be true most of the time, but not at first. And so when we're thinking about marginal costs, it's important to remember that they are used by companies to determine how much quantity they should produce. And if producing more is going to increase or decrease profits. Because if you're going to produce more of a good, you want to understand what is the additional cost of producing that one additional unit of the good. So that's kind of why a lot of companies that produce like physical goods will use marginal cost as a benchmark to see if it makes sense to produce more of a good. Okay, so moving to average costs. As it probably makes sense, average costs are just the average amount of cost based on the fixed cost, variable cost, or total cost. And all you do is you simply take, so let's take a look at this first line right here. So let's say we want to find the average fixed cost. All you're going to do is take total fixed costs and divide it by the quantity. And that'll give you average fixed costs. And you can do that for variable costs and total costs. So not particularly complicated, but just kind of good to remember how to calculate the average. Okay, so now when we think about average cost curves, it's important to remember that they're not always decreasing. And what I mean by that is basically you usually start off with high average fixed and variable costs. As you produce more of a good, those start to decrease. But there is a point where those costs will start to increase. So it's not always going to be this constant decrease. Frequently, you'll see something where you hit a low point, and then from that low point, you start slowly increasing. So you kind of have another similar U-shape like we previously mentioned. So just kind of an important reminder that the average costs are not always decreasing. So when we're thinking about average and marginal cost curves, there's kind of this sweet spot where companies want to produce where their average and marginal cost curves meet. And we're kind of going to talk about that when we think about the average total cost curve and the fact that it's U-shaped, which is similar to the marginal cost curve that we can see right here. So why is the average total cost curve U-shaped? So the first thing is that average fixed costs fall. So average fixed costs are really high initially, and then it starts to fall. But at a certain point, average variable costs start to rise as well. So we're kind of at a decreasing point, and then average variable costs start to increase. So those are the kind of two reasons why the ATC curve, or the average total cost curve, is U-shaped. Okay, and this is kind of what I mentioned before, where we're talking about that intersection point. So the marginal cost curve crosses the average total cost curve at the average total cost curve's minimum point. So this intersection point right here, that is where average total costs are at a minimum. Where the marginal cost curve intersects the average total cost curve, that's when average total costs are at a minimum. And so you can kind of divide this graph into two sections. So you have the section on the left and this section on the right. So when marginal costs are less than average total costs, that means that the average total cost curve is falling. When marginal costs are greater than average total costs, that means that the average total cost curve is rising. So just kind of an important thing to remember, that there is the minimum point, which is the intersection point between the two curves. And then you have the point where marginal costs are less than average total costs, and where marginal costs are greater than average total costs. And these two those two bullets will always be true. So they will always be true for the average total cost curve and marginal cost curves. That's just kind of a general truth about the relationship between those two graphs. So just kind of an important piece to remember here as well. Okay, but of course it's not that simple. We have differentiation again. In this differentiation, it's between the short run and the long run. And so really what I'm talking about here is just the difference between kind of a short period of time versus a long period of time. So in the short run, it's really important to remember that some inputs are fixed. So like we have things like rent, mortgage, land, those things are fixed costs. You can't, if your business shuts down, you cannot stop paying those costs because they're fixed for some amount of time. But in the long run, all inputs are variable. So basically all costs are variable. So a company can move, it can, once its rent or lease is over, it can just leave that building. The company can sell the building that it's in, it can sell the land. So in the long run, every single cost is variable. And I kind of have this little blurb here that is just kind of a nice little like summation of that, and summation of the relationship between the short run and long run, specifically for marginal costs. So in the short run, marginal cost decreases due to increasing marginal returns. In that increases due to decreasing marginal returns, which we talked about, and the law of diminishing marginal returns. So basically the idea that you are getting less quantity as you add more workers. And then that kind of relationship triggers a change in average costs, so variable and total. But then in the long run, that kind of relationship breaks down because you don't have fixed costs. All you have are variable costs. Everything is variable. And if you need to get out of your lease, get out of your current land that you own, you can do that. So just kind of an important distinction between short run and long run. And let me pause here to see if anyone has any questions. Okay. So now that we're thinking about long run costs, let's think about long run average costs. So when we think about long run average costs, there's frequently, it's frequently important to kind of think about the quantity produced, because you usually have situations where a firm is going to kind of stay a certain size. And so they have costs based on that size. So like we can see, for example, with the ATCS, that is a small factory size. So that is the firm's average total cost curve if they are a small factory. But if the firm is producing a larger quantity, then the firm is going to maybe increase their factory size. So when they increase their factory size, that's going to move their average total costs from the small to the medium. And then if they increase the factory size even further, that's going to move their average total cost from the medium to the large. And so each one of those factory sizes has its own unique average total cost curve. And the reason for that is just because as you change the size of something, that changes your costs and your ability to produce a certain quantity. So just kind of that distinction there as well. And what we can see is that when we have average total costs over kind of multiple different sizes, what we do is we can actually take those curves and come up with a combined long run average cost curve. In that long run average cost curve actually tells us where a firm is going to produce. So we can kind of divide it based on that. So in this, this is going to be, the firm will keep the factory size small if it produces less than QA. If the firm produces more than QA, but less than QB, a medium-sized factory is going to give it the lowest average total costs. And then anything over quantity B, the firm is going to choose a large factory size. So depending on what quantity the firm produces, that's going to change what size of factory the firm is going to have, because its average total cost curve is going to be lower at different quantities. So if we're at this point, we're going to be small. This point, we're going to be medium. In this point, we're going to be large. So it just kind of depends on the quantity we produce. So a long run cost curve is usually going to look something like this. Basically kind of like a bathtub shape, or like a really, really stretched out U. In firms have multiple short run average total cost curves, and you can see that here. So each one of these little black curves is a short run average total cost curve. And we just kind of sum all of those together to see the lowest point. And the lowest point is usually going to give us a shape like that, kind of a bathtub U shape. So when talking about that, we should think about kind of what is the scale of production. And there are usually 3 different types of production scales. So we have economies of scale, where the average total cost curve is falling as quantity increases. So kind of this point right here. So that's economies of scale. Then we have something like constant returns to scale, where the average total cost curve stays the same as quantity increases. That's going to be something like this, and that'll be CS. And then finally, we have diseconomies of scale, where the average total cost curve is rising as quantity increases, which is going to be, I'll say DS. Okay. So now let's take a look at a potential exam question. Okay. So I'll give you all 3 minutes again to answer this, and then we will go over it. This one's luckily a little easier, hopefully. Okay, and 1 more minute to answer if you have not already answered, and then we will go over the question. Awesome. Okay, it looks like everyone has answered. Cool. So let me close it. And let's take a look. Okay, so pretty split. So let's go over the answer to that and see why that is the case. Okay, so the question's asking us what type of returns to scale does this company have? So we are given a quantity and long run total costs. So all we have to do for this question is just compute the average long run total costs at each quantity. And so basically how we do that is we just take the long run total cost divided by the quantity. And we just do that for every single quantity. And we can see that the average long run total costs are increasing as the firm produces more of the good. So we're basically seeing that as the quantity increases, long run total costs are increasing. Does anyone have any questions on that before we move on? Yeah, let me go back. So let me see. Top hat crash. It should be diseconomies of scale because you're seeing the ATC rise as you produce more of a good. But I think it actually, yeah, so I messed up the correct answer in top hat. It should have actually been diseconomies of scale, not economies of scale, because you're actually seeing here the average total costs are increasing as you produce more. So yeah, so the correct answer should be, and let me write it, diseconomies of scale. And the reason for that is just the ALRTC. So the average long run total cost, that's going to be increasing as you produce more of the good. So yeah, my bad, diseconomies of scale, not economies of scale. Okay, so then the final piece here is just kind of thinking about, yeah. Yeah, sorry about that. Looks like actually less people got the original correct answer. So, but that doesn't matter, just participation. But yeah, definitely make sure to understand these three types, because I can guarantee you that something like that will be on the midterm. So make sure you know what an economy of scale is, constant returns to scale are, and diseconomies of scale, because those will be at least one question on the midterm will have something to do with the differentiating those three. Okay, and then, so when we're thinking about economies of scale and diseconomies of scale, it's really important to remember and kind of think about what those mean. So they're not just kind of like random things that we throw out, they do actually mean something. So economies of scale are actually occurring when there is increased production and it allows workers to specialize on a particular type of task. So like workers can become more efficient rather than like making an entire car. Maybe a worker is focused on just making the motor or just making the upholstery. So that's going to be more efficient. because that allows workers to get more efficient at producing that one specific type of good. And usually that's more common when quantity is low. So then we have diseconomies of scale. In this, you can kind of think about because there's like a coordination problem. So like a really, really large organization, frequently what happens is like it's so large that the company's management can't actually fully understand what is happening at the lowest level. And because of that, they can't really control costs. And so basically, that just means that the average costs are just going to start exponentially increasing. And that's usually common when quantity is high, just because the company's so large, it's really hard to for it to have a good understanding of kind of what it's working on. Okay, so then that is it for chapter 13. So I'm going to now switch to go over the questions that you all asked. So if you did not have a question or want to spend your time doing something else, totally fine if you leave now, but I did want to go over the student questions that were asked in Top Hat. Okay, so let's first take a look at common resources, at a lot of questions on this and kind of the free rider problem. So common resources and the free rider problem are basically just the idea that if a person does not have to contribute to a resource, but they can use the resource anyway, they have an incentive not to contribute. And so I kind of had, I thought of an example for like, so let's say your neighborhood throws a block party and everyone in the neighborhood is supposed to pay $10 to go to the block party, but that $10 payment is not enforced. So if you live in the neighborhood, you can go to the block party, even if you don't pay the $10. So then the incentive is everyone's going to have an incentive not to pay the $10, but still attend the block party because you get the benefits of the block party without the costs. And usually the situations where there's a free rider problem, that is where the government will intervene to kind of solve that problem. And so free rider problems are usually really common with common resources. And so that's why the government usually provides, either intervenes or provides common resources, because the government is basically a way to have everyone pay for that specific good. So another question was asking about the social cost curve and why the social cost curve was above the regular supply curve. So good question. So that's really important to kind of understand what a negative externality is. So the social cost curve is basically always above the supply curve because the social cost curve, which is the red line here, reflects when we internalize the negative externality. So like, for example, let's say the cost of gas. So the cost of gas should be higher. And it should be higher because of the negative externality that comes with consuming gasoline in cars. So for example, you have pollution, it contributes to global warming. And so because of that, the social cost curve should actually be higher. And it should be higher along the entire supply curve. So we can see that in this kind of rough example, the original equilibrium is $3.25 and the quantity is 30. But when we have the social cost curve, which internalizes the externality, you have the price of $4 and the quantity of 25. So basically it's pushing the price up and decreasing the quantity. Okay, so someone asked about barriers to entry. And so barriers to entry usually refer to like high costs, government regulations, or other obstacles that keep other firms from entering a market. So like, for example, the taxi medallion system in New York City, that's a really good example of a barrier to entry, because if you don't have a taxi medallion, you can't legally operate a taxi in New York City. So just kind of an example of what a barrier to entry does. Another question that was actually kind of interesting was, so talking about free entry and free exit of firms. So basically, if a firm can freely enter a new market or freely exit a market, that is almost unheard of. That is very, very rare. And so just kind of in general, like a lot of the topics we talk about in this course, a lot of the things we talk about are not actually real in the real world. It's usually much more complicated, but we kind of simplify to kind of just get a general understanding. Okay. Another question was asking about how do you differentiate a common resource from a natural monopoly? So the big thing here is that common resources are not excludable, but rival. So basically you can't stop people from consuming them, but if I consume the good before you do, that means that you don't have the good to consume. And common resources are usually a public good. Whereas club goods are natural monopolies, they're excludable. So basically they have like a price or kind of some way to exclude people, but they're not rival. So if I'm, watching a movie at a movie theater and it's not crowded, you can also watch a movie in a movie theater at that same movie theater and also not be negatively impacted by me being there. Okay, so another question I had, I believe this was from the chapter 10 post-lecture quiz. And it was basically trying to think about the Coase theorem, but a kind of specific application of the Coase theorem. So in this example, there is a hiking lodge where visitors try to use the river for recreation. There's also a fish cannery that dumps industrial waste into the river. So this pollutes the river. It makes it less desirable to people to come visit. So when we're thinking about that, kind of similar to the prior question, I tried to highlight the important pieces that you should take away from this question. So the first thing is that if the fish cannery uses a recycling method, their profit is going to be $1,300. And the hiking lodge's profit is $2,300. If they don't use the recycling method, the fish cannery's economic profit is $2,100 per week, whereas the hiking lodge's profit is $1,100 per week. So what we need to do then is just determine what the total profit is for both businesses under both scenarios. So we can see here that we just add up the fish cannery hiking lodge's profits under the no recycling and recycling. So we can see that under the recycling scenario, the profits are the largest possible. So we know then that the Coase theorem tells us that it depends on who has the right to that resource. That's how they're going to bargain. So let's say in the first scenario that the hiking lodge has the property rights to the river. And so because the hiking lodge has the property rights, they have the right to a clean, unprotected river. So what we can then say is that in this case, if the two firms can bargain at no cost, the fish cannery will use the recycling method and will pay the hiking lodge $0 per week because the hiking lodge has the right to a clean river. So if the fish cannery pollutes, they're actually in violation of the law. So they don't need to, the hiking lodge doesn't need to get paid by them because they have the rights to a clean river. So now the next scenario is, let's say the fish cannery is the owner of the river, and that by being the owner of the river, they can pollute it. So if they can pollute it, all we're really saying then is that the two firms can bargain at no cost. The fish cannery is going to use the recycling method, but then the hiking lodge is going to pay the fish cannery between $800 and $1,200. So basically, the difference between its profits to try to get them to, or not to get them, so they will not pollute. And so then ultimately what we can see kind of from this scenario is that the river is not going to be polluted because under both scenarios here, whoever has the rights to the river, the fish cannery is going to use the recycling method in both scenarios because that's going to be the method that benefits it the most. Okay. The next question was from chapter 11 post-lecture quiz, number 3. So this is an important question to understand, because this question, there will definitely be a question similar to it on the midterm. So basically what you have is you have kind of the two different types of pollution reduction. So the first is the government sets the pollution standard, which is the command and control method that we talked about. The second method is the government just allocates pollution permits. And so we can see here that we have a table which basically tells us the cost to eliminating 1 unit of pollution for firm X is going to be $130. Eliminating the second unit of pollution for firm Y is going to be $115, and so on. So let's take a look at the first method, regulation. So the government requires that each firm reduce pollution by 2 units. So all we have to do is just add up these two numbers for every firm to get the total cost, which in this case is $1,850. So regulation method's pretty easy to come up with the cost. The second method, though, the tradable permits, this method is quite a bit more complicated. And the reason for that is because the government has to set a price to reduce pollution by a certain amount. So really the takeaway here is that for a firm to reduce pollution, what you have to do is you have to look at the firm's cost of the third unit of pollution. And I know that seems kind of counterintuitive, but remember here that the government wants to reduce pollution by a total of 6 units. So ultimately what you have to do is look at this final unit of pollution to see how much the government needs to set their pollution permit price at. So we can see that the government needs to set their price between $212 and $219. So basically just some amount less than 220, but more than the next amount, which in this case is going to be 165. And so the correct answer for that one was between 212 and 219. But then the next piece we get is we're actually told that the government has set the price of a permit at $218. So now it gets kind of complicated because we actually have to determine who is going to trade permits. So each firm is given 2 permits, and then they can either don't buy, don't sell, or sell 1, buy 2, sell 1, or sell 2. So what we need to determine is who's going to sell the permits. So we know that firm X, and if I go up, firm X here, their cost to eliminate pollution, the first unit is 130, and the next is 165. So because of that, they are not going to buy or sell pollution permits. But let's take a look at firm Y. So firm Y we see here, they have very low pollution reduction costs. And because of that, the cost to that firm, they're actually going to trade a permit because they can earn more money selling a permit and reducing that unit of pollution. So if we just scroll down here, we can see that firm Y is going to sell a permit to Z. And by doing that, they're actually going to come to a total cost of $1,240. So we can see here that by doing the regulation of the pollution permit, the regulation part is actually going to be cheaper, or sorry, the tradable permits is going to be cheaper than the regulation. And that's kind of the point, is basically trying to understand that economists generally prefer tradable permits or taxes to some sort of regulation. That's just kind of the general thing that economists tend to prefer, because it can be cheaper to get the same amount of pollution reduction. And the final question was looking at a cost benefit analysis. So the college was basically trying to beautify the campus, and they found that the campus initiative would cost $6,300. And so to decide if it should be undertaken, what they did was survey the 470 students, and their willingness to pay, as revealed in the survey, was $14. So all you need to do to just determine if they should undertake the beautification is just do the 470 times 14, which gives you 6,580. And so because the benefit is greater than the cost, the college is going to undertake that beautification initiative. Okay, well, that is